I'll quit smoking this year. No, this is not what I am saying, but this is what millions of smokers promise themselves every new year. And most years, nothing really changes. But this year was different. The government took the same resolution too. And instead of advisor awareness, no Mukesh was hurt, they sharply increased the tax across tobacco products. But here's the twist. The first ones to react were not smokers, but investors. Within just 2 days, tobacco stocks crashed. 70,000 crore of market value disappeared. ITC fell 15%. Godfrey Phillips India fell an even sharper 19%. So if you're stuck in ITC after this fall, or you're thinking of buying because the price suddenly looks too good to ignore, stay with me till the end while I break this down for you. First, let's start with what actually happened. At first glance, this didn't look shocking. After the September GST 2.0 discussions, investors were already prepared for cigarettes moving into the highest tax bracket. So when the announcement of GST being increased from 28% to 40% came, it wasn't a shock. Plus, tobacco has always been treated as a sin category, and this wasn't the first time taxes were raised. Yes, the hike is high, but it was expected, right? If you remember, back in 2017, when GST and compensation cess were introduced, ITC fell nearly 15% in a single session, erasing close to 60,000 crore in market value. At that time, the markets were not prepared clearly. But once the dust settled, the outcome was very different. Cigarette companies passed on the higher taxes to consumers, and it worked for them, thanks to addiction, brand loyalty, and limited legal alternatives. They were able to raise prices without a sharp fall in volumes. ITC raised prices by 4 to 8%, kept operating margins intact in the 34 to 39% range, and over time grew net profit from 10,477 crore in FY17 to 35,351 crore as of FY26. From the 2017 lows, the stock eventually doubled by July 2023. This taught the investors that short-term panic can be very different from long-term business reality. So naturally, investors tried to apply the same playbook again. But this is where the mistake begins. As Sir John Templeton famously said, the 4 most dangerous words in investing are, "This time it's different." So let's understand what is actually different this time. What makes this tax hike different from the past is not just the rate, but the power it gives the government going forward. Hear me out. Earlier, cigarette taxes had a safety lock. If the government wanted to increase taxes, it had to go through the GST Council. So changes didn't happen overnight. But now, taxes can be changed much faster, and the markets hate that kind of uncertainty. Earlier, cigarette tax included something called the compensation cess. It had 2 parts. First, a fixed charge of 2,076 to 4,170 on every 1,000 cigarettes. And second, a percentage-based tax between 5% to 36% linked to the cigarette's length and price. Both of these have now been completely removed. On paper, this looked like simplification, but no, it isn't. Because what replaced it was far more rigid. Along with GST being raised to 40%, the government has brought back central excise duty, but not the old version. Under the new system, cigarettes are taxed purely based on length, with rates ranging from 2,050 to 8,500 per 1,000 sticks. The longer the cigarette, the higher the tax. Now here's why this matters. Excise duty is charged at the factory gate, that's at the manufacturing level, and it's a fixed rupee cost, not a percentage. This means the cost impact is immediate and cannot be easily absorbed through discounts or pricing tricks. Earlier, increasing cigarette tax was like turning a big wheel. Slow, heavy, and visible. Now it's like flipping a switch. Excise duty can be changed through a single government notification without GST Council approval. The second major change affects smokeless tobacco products like gutka and pan masala. Earlier, these companies paid tax based on sales. Now tax is payable on production capacity, not on how much is actually sold. So even if a factory sells less, it still pays on what it can produce. Now, if we bring all of this together, we are looking at a structural shift. Starting February 1, 2026, GST moves up sharply from 28% to 40%. The compensation cess, both fixed and percentage-based, is gone, and excise duty is back in a much tougher length-based form. And on top of that, smokeless tobacco moves to capacity-based taxation. So as you can see the numbers on the screen, the framework becomes simpler but more stringent for the industry. This is what really shook the market. Now let's go back to ITC. Back in 2017, ITC took a hit when GST and cess were introduced. But once pricing power kicked in, the company recovered. The question investors are asking now is simple. Can ITC do the same thing again? On the surface, ITC still looks strong. It remains one of the largest cigarette players in the country at a market cap of around 4.38 lakh crore, with some of the strongest brands in its portfolio. From a profitability perspective, ITC remains strong. ROC is close to 37%, ROE is around 27%. These are exceptional numbers for a large regulated consumer business. But at a group level, ITC's performance is still uneven. ITC Hotels has been demerged, so that cushion has gone. The cigarettes business remains the core profit engine, grew 4.3% year-on-year in Q2 FY26. But most other segments, including agri and paper and packaging, have been either flat or degrowing. The paper boards and packaging business remains pressured by low-priced imports and elevated wood costs. And non-cigarette FMCG, while delivering mid-single-digit revenue growth, continues to operate at suboptimal EBITDA margins of 9 to 10% amid high input costs and competitive intensity. Sure, their IT subsidiary has performed well this financial year, but it is operating in a slowing demand environment. So clearly, cigarettes remain the economic core of the group. In FY25, ITC cigarettes business posted a segment revenue of 35,894 crore and nearly 59% profit before interest and tax or PBIT margins. Operating cash flows have stayed above 17,000 crore annually for the last 3 years, and relatively low capex requirements mean strong free cash flows. That's why ITC comfortably rewards shareholders with dividends, currently offering a dividend yield of around 4%, all thanks to their tobacco business. So yes, diversification has helped revenues, but profits and cash flows still come from cigarettes. And that's why this tax change matters so much. There's another question investors keep asking about ITC. Who's really in charge? Because ITC has zero promoter holding. The answer is simple. ITC is a professionally managed company owned largely by institutions. Domestic institutions hold 47.4% and foreign institutions about 37.4%. But within that foreign holding, one name matters a lot: British American Tobacco. It holds its stake in ITC through its Indian arm, Tobacco Manufacturers Limited. And over time, that stake has been coming down steadily, from 24.01% in December 22 to 17.79% by September 2025. In fact, in May last year, BAT sold 2.5% stake via a block deal, which alone led to a 4% fall in ITC share price. Whether more stake sales happen or not is unclear. And if I talk about the domestic holdings, ironically, insurance companies dominate, owning 20%, with LIC holding a major chunk. Also, there are big mutual fund houses which hold about 14.3% in the company, with names like SBI MF, ICICI Prudential, Nippon Life, UTI, Mirae Asset and Parag Parikh. And that one is worth pausing for, because Parag Parikh follows a strict value investing approach, and ITC forms about 4.5% of the fund's portfolio. More importantly, in the latest quarter, the fund increased its holding in ITC from 1.01% to 1.17%. Funds like this add only when they are comfortable with value, which tells you something, but it doesn't end the debate. So let's see how analysts are reading this. According to Jefferies, the road ahead looks challenging. Cigarette taxes rise by nearly 50%, so to protect margins, companies may need price hikes of around 40%. And in a price-sensitive market like India, that's risky. So steep price hikes could hurt demand, shifting the problem from margins to volumes. As a result, Jefferies has cut ITC's earning estimates by around 15%, citing weaker volumes and poor near-term visibility. While ICICI Securities estimates the new excise duty raises costs by 22 to 28% for cigarettes in the 75 to 85 mm category. That's roughly 16% of ITC's cigarette volumes. This could force 2 to 3 rupee per stick price hikes. And history shows us something important here. When cigarette prices rise sharply, consumption doesn't stop overnight. What usually happens instead is downtrading to cheaper options or a shift to illegal channels, which again brings volume risk into focus. So where does this leave us, the investors? It brings me back to where we started this video. I'll quit smoking this year. Mark Twain once said, "Quitting smoking is easy. I've done it hundreds of times." So, smokers will adjust. But will the investors? Because in markets, late reactions are the most expensive risk. If you found this breakdown useful, hit like, share it with someone tracking ITC or the tobacco space, and subscribe for more filtered, data-driven market analysis. Also, do let us know in the comments what do you think. See you in the next one.
3, 2, 1, action.
I'll quit smoking this year. It had two parts. It had Mark Twain once said.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.